Well, hello again, Solis family. Greg Solis here with our update on the family front. Well, we got spring break coming up here real fast. April is a crazy month here in the desert. For those of you that don't live here, what you probably don't know is this is like festival month. We have 2 sets of Coachella. We have Stagecoach, a lot of young people coming in town, a lot going on this month. And then, of course, Emily will be on spring break. Nicole's coming in town, so we're fired up for that. She'll be in town during Emily's spring break. Of course, they're going to go to Coachella together during the first week, and so they're fired up. So that we're excited too. We're excited to have Nicole in town. Jack, for those of you, I'd mentioned during the last commentary that he had played in the Canadian Q School. Unfortunately, didn't come out where he wanted, but he had a pretty good showing. He shot 3 under the first day. And then he kind of fell back. After the first day, he was in the hunt, but then things kind of didn't go the direction he wanted. But he's grinding out there. It's pretty fun. He flew to Alabama and just had a great experience, and he seems to be getting a lot better. I actually played with him here the other day, and I was like, wow, he just really, really is playing well. So hopefully keep him in your prayers, and he'll start having some better results. But he's got all the optimism in the world and all the confidence that it will happen. It's just a matter of time, as he says. But anyways, on the family front, we're doing well. We're excited for Easter. I hope you enjoy the holiday. And my very best to your family as we go into this holiday season with Easter. Market-wise, yeah, it's been a little bit crazy here. The banking debacle, as I said last time, was really concerning. But we felt very optimistic that it was going to be somewhat isolated. We didn't see it as a systemic issue. Where there was going to be a big run on all the banks. The Fed was clear that they would come in as the backstop and make sure that the banks stayed healthy. I think the confidence has been restored back into the banking industry. And so it appears as though the concern and the crisis is going to kind of go away a bit. And now we see the markets beginning to focus again on business as usual, which is inflation. What's going on with inflation? So we think the banking story will continue to fade. We'll start focusing again on inflation, and then we're going to be looking at first quarter earnings that'll be coming out in the next couple of weeks. And so that's really what the market's looking at now, and that's why we got a pretty good rally. Last week was much, much better. We saw the equity markets bounce up. The S&P 500 is still off right around 15% from its all-time high that we hit back in January of 2022. So we're off still quite a bit, and the bond market, as we know, is it's stabilized. And we do think that as the Fed begins to slow down raising rates, we might see the trend line on rates just kind of stay somewhat more stable. So the bond market should remain a little bit more stable going forward. And again, the good news here, as I've said before, is with the higher interest rates, we're getting paid nicely on our bonds, which again, for over a decade, I haven't been excited about buying short-term treasury bonds, for example. So we have been making a move into some short-term treasuries, which, by the way, if you have money sitting on the sidelines that are in banks, especially if you're over the 250,000 FDIC insured portion, you might consider putting those funds into short-term treasuries. We're able to get up over 4% on treasuries. As a matter of fact, the 3-month treasuries are over 5.5%, about 4.6% thereabouts. So now the problem is we have what's called an inverted yield curve. So the short term is yielding higher than the longer term. So the 10-year treasury is at about 3.5%, but we got the short-term treasury or T-bills up over 4.5%. That usually is a signal of a problem of things to come. The market's telling us that we see a recession in the future, which we do believe will have some sort of a mild recession, but we just don't see it being a deep, long recession. So we still feel very cautiously optimistic that the market has priced in most of the bad news. Valuations are a little high right now, but we think that as we come out of this and we have a soft landing in the economy and don't go into a deep recession, we think there's some room in 2023 for the equity markets to rally. So we remain optimistic. We think a soft landing could be orchestrated, kind of a Goldilocks period of lower inflation, but still slow growth on the economy. And if that's the case, we could see a market that continues to rally. And meanwhile, getting paid a little better on our bond portion of our portfolio sure is nice. So we remain optimistic, but it will continue to be pretty volatile. So of course, hang on tight. If there's questions or concerns or anything else we could do for you, as I always say, we are here. We are doing some rebalancing behind the scenes to position these assets properly as we move forward. If you need us, call us. Otherwise, we'll stay in touch. Take care and God bless.